Good morning, everyone, and welcome back to a new series on PwC's Boardroom Forum Live, particularly focused on financial reporting as well as sustainability reporting. My name is Shreeya Jugnandan, an Associate Director at PwC's Corporate Reporting Services. And joining me for this first episode to share some very important year-end financial reporting reminders is Renshia van Noordwyk. Welcome back to the Boardroom Forum Live series, Renshia.
Thank you, Shreeya.
Renshia is a partner in the Corporate Reporting Services team. And in this conversation, we're going to be chatting about some year-end reminders, but not particular to any specific year-end. Rather, we're going to keep it pervasive and challenge ourselves to keep things quite practical as we navigate certain common pitfalls in financial reporting. Now, I think we can all agree that whether you're an investor or a user of financial statements, or even someone within the assurance space, quality remains number one. It's quite concerning that over the last few years, as part of, for example, the regulator, the JSE's financial reporting proactive monitoring process, year on year, we tend to find issuers needing to restate or amend their financial statements. For example, within the last review cycle in 2024, around 14 issuers had to either restate or make subsequent amendments to their financial statements. This is in addition to 11 issuers that had disclosure deficiencies. Those stats are quite concerning, Renshia. What do you think?
I agree, Shreeya. Quality needs to be at top of mind, and every one of us has the responsibility to make sure that that quality in financial reporting is upheld.
Definitely. So I think keeping with this theme of quality and common pitfalls, the first question isn't necessarily what these errors are, because we'll get to that in a moment, but why? Why do you think we tend to make errors in quality when it comes to financial reporting?
That's a good question, Shreeya. So in my opinion, I would categorize the why in two broad categories. The first category I would put into what we call the technical accounting side. So business is complicated, IFRS accounting standards are complicated. So there comes, as a result of that complication, there is potential for errors. That's the one side of the coin. The other side of the coin is the practical side, as you mentioned. The processes around the financial reporting that's in place. Are the controls in place to make sure that there's a robust review process and things in place to make sure that the quality output is there? So I would categorize it into these two broad buckets.
Principles and practice. I like that. Let's keep going with that momentum, Renshia. So a component of what you said is actually the inherent complexity of financial reporting and accounting as we have it today. Can you take us through your thoughts in terms of what people are getting wrong in this domain?
That's a good place to start. So if we think about where do we start with financial reporting, it's probably you're not going to start with a clean slate. That doesn't make sense every year. So most companies start with what we call a roll forward. So you had a set of financial statements that was released last year, probably of a good quality, and that's your starting point. But preparers need to understand that that's just the starting point. Once you have done your roll forward, you then need to assess what's new, what has changed. As we all know, accounting standards are not static. It keeps on evolving. So you have, in most financial years, new accounting standards or amendments to those accounting standards to assess and address in your reporting to make sure that, is this something that's going to affect me or not? And if yes, how do I update my financial reporting for those changes? But then there's also not just the formal changes in financial reporting, there's also the interpretations committee that comes out with new interpretations. The latest example of that is probably the interpretations committee's response around a question that they were asked around segment reporting and how we look at certain disclosures in our segment report. So nothing in the standard has changed, but as a result of that interpretations committee ruling, we had to make certain changes in financial reporting. Now we're looking at, that is the general changes. You also need to look at what has changed in my company. So what's new? Did I have a new business combination? Did I have a restructuring? Did I have a disposal? Did I have a potential impairment trigger that wasn't there last year? And all of that needs to come through in the financial statements. And that links back to what you've mentioned in the JSE proactive monitoring report, is one of the comments that they make there is that the financial statements need to tell the story of the company. So part of that is for the company to look at what is relevant in the current year that needs to tell the story for the company for that financial year.
And I love how you just expressed those points, Renshia. So in my mind, it's almost as if there's two spheres of thinking. There's updating in the accounting realm, and there's updates to your actual business, your actual organization. And I see the financial statements positioned in the middle of this Venn diagram, this overlap, telling the story of these two components.
Exactly. And once you have a better picture in terms of these two stories, what you need to overlay that with is materiality. So remember, in financial reporting, it's about material information to the users of financial statements, bearing in mind that when we talk about materiality in financial reporting, it's not auditor materiality, it's entity materiality. So again, from a JSE perspective, the ask was that a company needs to develop a robust materiality framework against which they can then assess what information is material to a user and needs to be incorporated into the financial reporting.
This is good material thus far, Renshia, but let's take it a step further. So as a technical partner in the firm, I'm sure across your desk you see all sorts of interesting accounting nuances, some interesting accounting complexities. What are people getting wrong out there, Renshia? What are some of those technical points you've seen?
Yeah, so I know we don't like to talk about what has happened wrong and what went wrong in the past, but unfortunately, we learn from our mistakes. So hopefully we learn from our mistakes. So if we have to summarize what are the topical areas where companies need to focus to make sure that they don't step into the same pitfalls, is one of the culprits that tends to result in material errors is the cash flow statement, unfortunately. And that's not just from what we packed up from our internal processes, but also from a regulator's processes. It is identified as one of the areas where there's probably the most common area where there's errors occurring. And if we think about the cash flow statement, there's a multitude of things that go wrong. It is firstly not eliminating non-cash items from the cash flow statement. Secondly, it's around misclassification between operating, financing, investing, and not putting it into the right category. But then there's the offsetting issues, but also the identifying of cash. So what is cash and cash equivalents for the purposes of my cash flow statement? Now, thinking back, why does the cash flow statement remain a culprit? It's probably because it's one of those statements that's very complex to complete, but also probably done quite late in the process.
Yes.
So the ask is, make sure that you've got enough time to complete the cash flow statement from a quality perspective. The second item I wanted to maybe mention is presentation. So if you think about your set of financial statements, there's probably a lot of focus on what we call the primary financial statements. And there is an accounting standard that helps us identify what are the specific items that needs to be presented specifically on those primary financial statements. So we've seen quite a few people getting that wrong and not presenting separately items that needs to be presented separately. Or, for example, getting the classification between current and non-current not right. That requires a restatement.
So make those primary financial statements your primary focus.
Exactly. Then the last point that I wanted to flag, and this is probably taking us into a big, what people feel like a big dark world, is financial instruments.
Oh gosh.
So I think people don't always realize that the financial instrument standards around presentation and disclosure is not just for financial institutions.
Not just for the banks, Renshia.
Not just for the banks or insurers, it's for every corporate. If you've got exposure to credit risk in the form of debtors, loans to intercompany company members, etc., if you've got liquidity risk, or you've got debt that you need to repay, exposure to other market risk like interest rate risk, foreign exchange risk, all of those are relevant in financial risk management disclosures. People tend to oversee that or not spend enough time on that. And they need to make sure that the story, again, comes through in terms of identifying what are the risks that they are exposed to, what are the processes in place to manage that risk, and how quantitatively is the financials exposed to that risk. One of the common areas that we see in a corporate environment where it gets missed or oversight is, for example, companies concluding that the expected credit loss is immaterial and therefore we don't have to say anything in our financials because it's immaterial.
We've seen that often enough.
We've seen that often enough. But on the standback test, the conclusion might be that the expected credit loss, so the income statement impact, is material, but the balance that is exposed to this credit risk might be a material balance. So a lot of the disclosure is around the balance, which is a material item, and then explaining what is this quantum that is exposed to, for example, credit risk, and how is that managed, and how did you get to the conclusion that the expected credit loss on that material balance is then immaterial? So again, telling that story to the users.
Renshia, you have to really have some empathy for preparers out there, because not only must we be quantitative whizzes, but also qualitative whizzes and try and stitch those messages together, the quantitative and the qualitative. But like we mentioned a bit earlier on, principles to practice. What are some of those practical tips, Renshia, you have for preparers out there in trying to bring all of this together?
So in my experience, what we've seen is, why do things potentially go wrong or become quite hectic in the financial reporting period is time. We have realized that there's not enough time left in the process at the end of the road to make sure that there's quality reporting coming through. So my big ask for preparers is to go and think back and work with a realistic timeline. So work backwards from when is my reporting deadline, backwards to how do I make sure that I've got the milestones in place in order to meet that end deadline.
Project management is key.
Project management is key. Bearing in mind that there's a lot of processes that needs to happen in between, including reviews of those financial statements internally, even before it gets to the external review. And that's probably another area where we believe that there's a bit lacking at the moment, is potential the oversight role. So is there sufficient oversight over this process, and that there's a robust internal review before the external reviews has to take place? And we all know we've got scarcity of resources in South Africa. So you need to make sure that you've got the skilled resources in place, make sure that they have been upskilled in order to manage this process that needs to happen.
Renshia, you mentioned skills, and I think that's my final question for this conversation. How do we possibly remain up to date with all of these activities? You mentioned the IASB, IFRS interpretations. There's a whole host of activity happening in the financial reporting landscape. What advice do you have for preparers out there to stay in tune with the latest and greatest in accounting?
And I agree, it can be daunting in terms of the information that needs to be updated and skilled up all the time. And I can't let this moment go to advertise that what we have from a PwC perspective at Offer. So we do have biannual formal IFRS accounting standards training, where we take people through what is the latest developments, what are things to look out for from a practical point of view, where we see things go wrong. Then there's also the shorter versions of webcasts, which is a snippet in terms of what is new things to think out.
Oh, I love those on YouTube.
Yeah, exactly. And that also links to some of our publications, which we call in briefs and in depths, that you can then explore if it's relevant to you as a company. And then, that's all the PwC resources, but there's also a whole host of other professionals that offer things in place, publications, trainings that you can make sure that you're up to date.
Thanks, Renshia, for your in-brief and in-depth insights in this conversation. That's all we have time for today. Like Renshia mentioned, project management is key in marrying both the technical issues when it comes to the financial statement process, as well as those practical elements. I know we spoke about dynamic change in financial reporting, so join us for our next episode in this corporate reporting series, where we will be covering the latest and greatest around IFRS 18, a new standard in the financial reporting universe.